If you think the housing market is stabilized, think again. According to Zillow, many U.S. metros could see meaningful price declines in 2026. And if you're not paying attention, you could get blindsided before it happens. The signs are already here, right now, quietly flashing like warning lights on the dashboard, while everyone else is singing along to the radio. Whether you're a first-time buyer trying to figure out when to jump in, a homeowner wondering if your equity is about to evaporate, or an investor deciding where to deploy capital next, this matters. Because if prices fall where you live, the consequences don't stay on the spreadsheet. They hit your net worth, budget, plans, stability, and likely your stress levels above all. In this video, we use Zillow to see which metros are most likely to see real declines, and some markets are way more vulnerable than others. We'll break down exactly what this forecast is signaling, walk you through the metros that appear most exposed, and explain why, using 3 deceptively simple, massively important indicators that most people ignore until it's too late. This way, you'll not only understand what might happen, but also how to prepare, whether that means buying smarter, selling sooner, or simply not panicking when headlines get loud. Let's dig in. But first, don't forget to hit like and subscribe to Housing Data Lab for more real estate realness. And leave a comment letting us know if your on-the-ground experience aligns with next year's projections.
Let's zoom out and look at the national picture, because this isn't just about a few cities. Something bigger is shifting beneath the surface. According to Zillow's most recent forecasts, U.S. home values are projected to rise about plus 1.2% over the next 12 months. That may sound tame, even optimistic, given the storm clouds gathering in many local markets. Here's the wild part. Earlier this year, in March-April 2025, Zillow's 12-month outlook was actually negative 1.7%, before bouncing back. So the national forecast has swung from negative to mildly positive in a matter of months. Why the flip-flop? Because 3 powerful forces are colliding all at once. More homes for sale, rising supply, fewer ready buyers, weaker demand, and growing desperation among sellers, more price cuts. Zillow reports that listings are lingering. The median active listing age is roughly 60 days, which is the longest stretch they've tracked. At the same time, more than 27% of listings had experienced a price cut in a recent Zillow dataset, a record high since they began tracking this metric. When you combine these elements, you get a market where sellers are losing power, buyers are getting more leverage, and the upward momentum in home prices is sputtering. That matters because even if the national number is plus 1.2%, it masks sharp differences at the metro level. Some areas will outperform, others will underperform, or even decline. Follow along, because next we'll look at the 3 key metrics driving those divergences.
So why is 2026 shaping up to be especially risky for some markets? It comes down to 3 data points that, when you line them up, paint a pretty clear picture of what's building beneath the surface. First, inventory is swelling. Zillow's data shows active listings climbing far faster than demand can absorb them. And yes, more choice is great for buyers, but it's terrible for sellers who suddenly have 5 nearly identical houses competing with theirs down the street. When supply rises this fast, prices tend to soften, sometimes suddenly. Second, price cuts are exploding in frequency. In some markets, the share of homes with reductions is climbing at a pace we have not seen in years. That means sellers are getting ahead of the curve and slashing expectations before buyers even show up. It's like watching someone walk down a staircase in real time, one listing at a time. Third, homes are sitting longer. Days on market keep stretching, and when houses linger, that shifts leverage dramatically. Buyers start negotiating harder. Sellers panic sooner, and comps begin to drift downward not because sellers want it, but because they're forced to chase the market. These 3 ingredients are the perfect pressure cooker. More homes available, more cuts happening, more time on the shelf. That's why some metros look especially exposed heading into 2026. And if these trends keep accelerating, they could tip more markets from cooling into declining surprisingly quickly. Understanding this isn't just academic. It's how you avoid buying at the peak or avoid holding the bag if your market turns.
Let's walk through 4 U.S. metros that are looking particularly exposed right now. The ones where Zillow's data, combined with local market stress, suggests real risk heading into 2026. First up, Denver, Colorado. Once the poster child of fast appreciation, now a red flag market. According to Zillow, a whopping 38% of listings in the Denver metro saw price cuts recently. Inventory here is building hard. One report shows active listings up almost 50% year over year. Meanwhile, homes are taking much longer to sell. Reventure found that days on market rose 15% from about 63 to 72 days. That's hugely significant. Buyers in Denver now have real leverage. Sellers are cutting, waiting, and adjusting, and if this continues, value could slip further. Second, Austin, Texas. This one's a bit of a déjà vu. Pandemic boomtown turned potential bubble risk. Zillow's broader data flagged Texas markets, including Austin, as having disproportionate price cut activity as supply piles in. In real estate media, Austin is repeatedly grouped with other overheated Sunbelt metros that are now overcorrecting. When you combine that with rising inventory, you get a potential slide. If the national forecast softens, Austin could be among those to watch closely. Third, Phoenix, Arizona, the Sunbelt darling that's suddenly not so golden for sellers. According to a Realtor.com market report, Phoenix hit 31.3% of listings with price cuts in May. On top of that, more aggressive reporting shows nearly half of active listings in Phoenix have had price reductions according to market tracking firms. That kind of scale in price cuts is not just some homes are soft, it's a broad-based recalibration, likely driven by inventory surge and buyers rethinking their budgets. Fourth, Nashville, Tennessee, maybe the underdog risk metro. Zillow's internal reporting, via their June cut share data, puts Nashville among the top metros in the country for price cuts, around 35% of active listings. That's huge for a market that historically leans seller-friendly. The surge in supply, plus deep cuts, could push Nashville into steeper downward pressure if demand doesn't bounce back. These 4 metros don't all have the same weakness. Denver's problems are more structural, built on long inventory buildup and stretched days on market. Austin and Phoenix are more speculative, warning signs from a boom unwinding. And Nashville is the sleeper risk, quietly shifting under the radar. If you live in one of these markets or are thinking of buying or investing in them, now is not the time to be complacent. The macro forecast may look mildly positive, but local cracks are real, and they could widen fast. Next, let's run through how these risks play out in different 2026 scenarios, including the worst-case knock-on effects and what can go right again if things shift.
Let's consider 3 plausible paths for 2026 based on where things could head from here. Think of it like different weather forecasts, sunny, stormy, and mixed, and knowing which one you're in could make all the difference. Base case, this is where Zillow currently sits, about plus 1.2% national home value growth from 2025 to 2026. Nothing dramatic, but growth. Not a crash, not a boom, just a gentle uphill crawl. That's the middle ground, where inventory increases slow a bit, but demand stabilizes, and sellers ease up on price cuts just enough for prices to inch up. Bearish risk. But it's not a done deal. Earlier in 2025, Zillow's outlook was minus 1.7%, and they may swing back there if supply continues to flood the market and buyers stay on the sidelines. That scenario assumes inventory keeps building, sellers keep cutting aggressively, and buyers don't rush in, the kind of downward pressure that could actually drive prices down rather than up. Regional divergence. And here's where things get really interesting. Not every market is on the same weather map. The biggest risk zones? Likely the Sun Belt, places like Tampa, Austin, Phoenix, and the Mountain West, including Denver. These are the metros where the data, cut share, and inventory stress lines up in a way that suggests real downside.
On the flip side, some Midwestern and Northeastern cities may hold up much better. Zillow has flagged metros like Cleveland, Hartford, and Louisville as more resilient. Inventory is tighter, builder constraints are more binding, and price cuts are less extreme. Finally, don't forget the big picture levers. Mortgage rates could make or break this. If rates ease in 2026, some buyers will wade back in and shore up prices. But if rates stay stubbornly high, demand could sputter and inventory could keep building. Also, new construction matters. If builders pull back, supply could tighten later. If they keep building aggressively, that adds more heat to the oversupply risk. So, bottom line, plus 1.2% is the baseline, but we absolutely can slip into negative territory in certain metros, and the divergence is likely to be stark. You need to know not just what might happen nationally, but where you live or plan to buy.
Here's what all of this actually means for real people. Because data is great, but decisions are what count. If you're a buyer, this might quietly be one of the best windows you've seen in years. There's more choice, more leverage, more room to negotiate, and fewer bidding wars. You might even catch a deal before a dip, or during one. But don't assume a crash is guaranteed. Zillow's national view is still mildly positive at plus 1.2%. This isn't 2008 all over again, so approach with strategy, not fear. The smart move now is knowing your market's direction, not letting headlines make your decisions for you. If you're a homeowner, especially in a higher-risk metro like Denver, Austin, Tampa, or Phoenix, this is not the moment to get greedy on price. Buyers have options, and overpricing could cost you not just time, but real equity. Think about your time horizon. Are you planning to hold for years, or do you need to sell soon? If it's short-term, be realistic. If it's long-term, a soft patch doesn't have to be catastrophic, but you should still understand the trend. And if you're an investor, this could be a rare moment where the best opportunities appear in the softest markets. Distressed listings, motivated sellers, exhausted flippers, the whole menu. But there's also a risk of thinner cash flow if values slip or rents stall. So don't invest based on the national average. Drill down to the zip code, the neighborhood, even the street. The people who win in markets like this use data, not instinct.
The forecast might look bold and decisive on paper, but here's the uncomfortable truth no one likes admitting. This is still a forecast. It's a best guess based on patterns in listings, inventory levels, and how long homes are sitting on the market. And as much as we love to believe the future is obedient and predictable, it isn't. One sudden macro shock, like the wrong interest rate move, or a surprise inflation spike, or a bad month for employment numbers, could flip this entire outlook on its head in a matter of weeks. And local markets love to rebel. Even if an entire metro is flagged as high risk, that doesn't mean every neighborhood inside it is doomed. Some pockets could surge while others cool. Some might flatline completely. We've seen this before. One side of the highway loses value while half a mile away, prices soar like someone forgot gravity. Builders might also slam the brakes. If inventory climbs too fast, construction slows, permit applications shrink, and the supply-demand scale quietly rebalances. What looks terrifying now could look boringly normal a year from today. So yes, the data is real, the risks are real, the trend lines are alarming, but housing markets are alive, irrational, emotional, and sometimes completely unhinged. These projections are based on what happens if all current forces continue in the direction they're moving. But if the wind changes, the map changes too. In short, treat this like a weather forecast. Respect it, watch it, take action where needed, but remember, no one controls the storm. The bottom line? The data, once the cautious voice in the room, quietly pivoted bearish and then eased back into a modestly positive outlook. Zillow's current 12-month forecast sits at roughly 1.2% growth, barely above flat. But beneath that calm surface, some markets are flashing warning lights heading into 2026. If you're thinking about buying, selling, or investing, this is not the moment to rely on national averages or generic advice from your uncle who bought a duplex in 1998. Pay attention to what's happening in your backyard, Track inventory. Track price cuts. Track days on market. Let the data, not the headlines, shape your decisions. And if you want an edge, dig into the research and follow us here for more updates. Make it part of your strategy, not an afterthought. Want to get into the forecast on a specific region? Comment below.